Well, good morning or good afternoon, depending on where you are as you join us today for our latest installment of the Institute of the Americas Energy webinar series. This is Jeremy Martin, Vice President, Energy and Sustainability here at the Institute of the Americas, and thanks for joining us. We're getting ready to start. We're very pleased to have a conversation and a presentation today with RoseAnne Franco, who's the head of oil and gas risk at Verisk Maplecroft. And as is the custom for our webinar series, we'll have a formal presentation of about 20-25 minutes, and then we'll have some time for questions and answers via the website, via the webinar platform, and I will moderate best to entertain all of your questions. Just a quick reminder of how that works before we get in too far into the introduction here. We have the chat function that's right there where I have said good morning, and we'll use that for the questions. So simply type your question in that bar at the bottom, hit return, and that'll pop up right there. And we'll use that function for the question and answer session, and we'll put those up. And again, for those of you who've joined us in the past, you know that it's never too early to start posing your questions. So feel free to immediately jump on there if you have something you want to write down and pose for RoseAnne, and we'll come back to them at the very end. Well, we are indeed pleased to be able to, as part of our latest installment of the Energy Webinar Series, take a look at the region and the oil and gas outlook specifically. So far this year, we've had several interesting webinars, beginning with one that looked at the Trump administration's outlook for the region, or impact and implications for the region. We've talked about sustainable energy development, as well as several other topics. And now we're going to specifically focus on the oil and gas outlook. And in discussing this, RoseAnne Franco from Burress Maplecroft has kindly agreed to present and come up with, I think, a very significant title, or at least the beginning of the title, The Race to the Top. And when RoseAnne and I were talking about the opportunity to have her present as part of our webinar series, she was pretty emphatic in that she wanted to share some of the good news that's coming out of the region and some of the things that are emerging in terms of positive trends as we get through 2017 in Latin America. So let me briefly introduce RoseAnne Franco, who I'm sure many of you know, and I've had the pleasure of knowing and working with for several years, dating back to her days at PFC Energy in Washington, D.C. RoseAnne, thanks again for joining us this morning. I don't think PFC Energy exists anymore, does it?
No, no, doesn't, not under the same framework, but there's still many of us floating around, former PFCers.
Not like the old salad days with the whole gang in Washington, right?
Yeah.
Well, RoseAnne has moved on and pivoted from that experience, and she's definitely somebody that I routinely talk to and really trust her insights on political risk and risk analysis and above ground elements of Latin America's upstream and oil and gas. And she's been doing that for over 15 years. And like I said, beginning at PFC, more recently at Wood Mackenzie, and now at Verisk Maplecroft, which I'll let you explain that sort of merger or acquisition between Verisk Maplecroft and Wood Mackenzie and how that, what that signifies. But like I said, delighted to have RoseAnne, and I think the element of this presentation is to get into a little bit of the positive trends as to what's happening across the region. I mean, we've talked a lot in our webinar series about Mexico and the oil and gas developments there, but we're also going to talk today about Argentina and Brazil, and there's a lot afoot in both of those countries in addition to Mexico. So without any further ado, I'm going to turn it over to RoseAnne Franco. But before I do so, I'm going to make a shameless plug for the La Jolla Energy Conference, which is our annual conference here, 26th annual this year, 24th and 25th of May, 1 month out, just around the corner. And this, lastly, we have some other upcoming events in Chile, Panama, Brazil, and Mexico. So please do join us. We'll continue to talk about some of these issues that I think RoseAnne will share with us today as part of her presentation. So RoseAnne Franco, over to you. Thanks again for joining us as part of our webinar series.
No, thank you, and I appreciate, Jeremy, the opportunity to join you guys. It's always fun to work with the Institute, and always good to talk to you all. So again, appreciate the invitation. So what I wanted to talk about this afternoon was, as Jeremy mentioned, some of the more positive trends coming out of Latin America. So we'll start looking at the regional developments when it comes to oil and gas, as well as on the political economic side of things. Then we'll look at some of the key countries, so Argentina, Brazil, and Mexico, and we'll end examining competitiveness. And I think that that is an issue that is increasingly coming up in the discussions that we have with clients. And it's actually a positive, I think, for the IOC. So we'll conclude there. So first, it's helpful to review where we've been. As many of you know, Latin America has been quite hostile to foreign investment over the last couple of years with rising government take, the return of national oil companies, regulatory volatility, a lot of these features that you see outlined on the left. Now, we argue that the region is undergoing a shift away from resource nationalism to what we term resource maximization, and that this will likely continue for the rest of this decade. How do we define this? Well, first, governments are focusing more on maximizing value from their natural resources, not just rents. They're taking a much more holistic view on the oil and gas industry, and so value is exemplified by employment generation and industrialization, in addition to higher revenues from growing oil and gas output. And also the fact is that resource nationalism has run its course. There's really little room to continue to squeeze operators. Second, states are pursuing more pragmatism when it comes to local content. It remains part of the equation, but governments are increasingly wary of these onerous minimums. And so you saw that with Mexico, and most recently in Brazil, there have been adjustments. Now, third, states are signaling much more receptiveness when it comes to FDI. And just if you were to look at the sheer number of licensing rounds that are planned for this year, which we'll recap later on, it's really quite astounding. And then lastly, with regard to your national oil companies, there's a demand for more transparency and accountability. And so what's really striking is that this is even before the Lava Jato scandal and the Odebrecht investigations. And so for IOCs, this translates into a much more improved environment, much more receptive host governments. And we anticipate that these conditions will only deepen over the next couple of years. So what are some of the drivers? And really that this will suggest the staying power of this shift. And so first, it's with regard to declining production that we're seeing in some of the countries, the major producer countries. I think Mexico is a great example of this, where output has stagnated. And so this does place pressure on fiscal accounts or on trade balances. And so this then becomes the trigger for energy reform, which is what we saw there. Another major factor is simply oil prices. Here at right, I've got the WTI benchmark, and this is in 2016 dollars. This is the annual average over the last 4 decades. And what you notice is when there's an acute rise in oil prices, it tends to be accompanied by regulatory volatility. And so if there's the increase in oil price, governments are looking to capture more of the upside. And if they can't, that's when you start to see unilateral action. So whether it's increasing government take or at its worst, nationalization, as governments try to reach a new equilibrium with the operators. Now that we're in a situation where oil prices receding from those record highs, it means that there's less pressure. This risk is reduced. So another major driver is simply the end of easy oil. You've got conventional fields that are declining, and so what's left for governments or for countries to be able to offset that reduction in output would be deep water or heavy and extra heavy oil, unconventionals or mature fields. And with all these options, they tend to require higher capital outlays or technical expertise that more often than not is not housed domestically. So once again, this does open the door for foreign partners and for foreign investment. And then the last major driver that I wanted to highlight is more from the corporate side of things, and that's the fact that that at the corporate level, that there's a move from volume to value strategy, and so there's much more scrutiny on companies on where they can achieve good returns from projects and generate cash flow within a reasonable time frame. So all of this heightens the need for Latin American governments to work even harder to try to attract investment. So moving on to the political economic picture, last year was really an inflection point. And there's a couple of reasons for that. And we'll start with the economic side of the equation on the left. As you can see here, we're at the bottom of a commodity super cycle with key commodities such as copper and oil collapsing from their record highs. And this has placed enormous pressure on fiscal accounts in producer countries such as Mexico, Colombia, and Argentina. Venezuela also comes to mind. And these governments have been forced to adjust their economic policies, and so some more than others, to be sure. But we expect this to have a cascading effect on investment policy. And you're seeing that in some cases, again, some countries a little bit more than others. You couple this with a gradually rising US interest rate. Our forecast for 2017, 2018 is for a more muted economic recovery in Latin America. If you move your attention to the right, into the political story, here we've identified major elections and other political events that have taken place over the last 2 years or so. Many of the governments in power have either, the result has been that incumbent populist governments have either lost their footing or have been rejected outright. And so we saw this in Argentina in November 2015, in Peru last year, with a right of center candidate winning the election, Pedro Pablo Kaczynski, and then in Brazil, with President Dilma Rousseff being impeached. Clearly, the political pendulum has swung. Now, the recent presidential runoff in Ecuador earlier this month, it places a bit of a pause on this trend, but there are clear indications that overall in the region that the status quo is on the wane. So what does this mean for oil and gas? We'll start by highlighting a few countries where the changes in the political economy have been the most striking, and that would be Argentina and Brazil, and we'll start with Argentina. So the country offers a really good case study on what happens when a country that was governed by types of administrations that favored state-led economic policy and then switched. We'll start with the economic story there. Here at your left, we're looking at GDP growth. Clearly, the country was applying an economic model that was no longer delivering. You have GDP plummeting in 2012. Then again in 2014, there was a bit of an uptick in 2013 and 2015, and this was largely due to elections and an injection of public spending. And as we noted early on with the bust in the commodity cycle, largely due to a slowing China, this helped puncture the growth story in places like Argentina. So foremost for the new Macri administration, the priority has been economic adjustment. And that resulted in the economic contraction that you see here for 2016, negative 2.2% growth. But looking forward, joined from our economic forecast from our sister company, Wood Mackenzie, recovery is in the cards this year and next, which then brings us to the political story. The upcoming midterm elections in October are viewed as a referendum on the president. His success rides in part on the pace of Argentina's economic recovery. Now, the president has been given leeway to carry out much needed economic adjustment, but the process has not been as seamless, and it rarely is. And I think that that's the lesson for us when it comes to Argentina and governments like it. They are operating and undergoing a transition, for the lack of a better term. And so these new governments have a tremendous amount on their plate coming into office after a decade or more of heterodox economic policy, and it takes time to unwind the multiple economic distortions. And so while it's not always a linear process, the country is turned in the right direction. Now, with regard to Macri, we expect that his Cambiemos bloc should increase its number of seats in Congress, but it likely will remain short of a majority, which means that coalition building will continue to be important for his administration. So what does this mean for oil and gas? Firstly, the priority for the new government was economic adjustment. Now, with that firmly underway, his administration has had a little bit more bandwidth over the last couple of months. And so we've seen recent progress with regard to oil and gas. And I think the recent Vaca Muerta deal is important to note, received a lot of press with regard to gas pricing. The recent agreement sought to support gas tariffs of up to $7.50 per million BTU for new shale and tight gas production, gradually declining to about $6 per million BTU by 2021. Now, to be sure, the industry was searching for something more permanent, perhaps more market derived. But what the agreement does do is that it gives the administration more time to devise a more permanent solution post 2021. With regard to labor, there have been some concessions that were related, that were an integral part of the new agreement, such as workers would no longer be remunerated for rest time or while they're in transit. It's important to note that the agreement only focuses on shale operations in Neuquén. So other areas of the country, such as the San Jorge Basin, they continue to deal with tough labor negotiations. So this is a step in the right direction, but it's only one segment of the industry. So there's still more to be done, but again, we're moving in the right direction. So moving on to Brazil, they're dealing with their own political transition and near-term volatility, in part because the person at the helm is the former vice president and now President Michel Temer. He's confronting legacy investigations, such as, well, in particular, you have the campaign finance probe that he's been implicated in. Now, despite all of this, the country has registered important changes in its oil and gas industry, particularly over the last 6 months, and I wanted to highlight a few. So one is with regard to the mandatory pre-salt operatorship for Petrobras. We finally got movement on that front last November with Congress relaxing this requirement on Petrobras for new pre-salt acreage. With regard to local content, there's been some slow movement towards granting waivers for existing operators. They did announce lower local content minimums for upcoming licensing rounds, so this will be a benefit for round 14 and the upcoming pre-salt tenders. And then the other major development is simply also expectation that state presence will begin to diminish overall. And this is in light of Petrobras's ambitious divestment program, the fact that they aim to unload some $21 billion in assets between this year and next, reducing positions in midstream and downstream as well as some in upstream. The consequence is a much smaller role for the national oil company, which translates into many more opportunities for private investment. With regard to challenges for Brazil, I think one is foremost supply chain. And what we mean here is that you have a local oil services sector that's debilitated, in part due to the Lava Jato scandal. You've got firms that have been charged, fined, blacklisted, and are operating with reduced capacity. This will take years to recover. And at the same time, companies are still saddled with their local content obligations. So, and the waiver process, again, the granting of waivers, there's still, as far as streamlining, there's still more that needs to be done on that front. And the last point that I wanted to highlight is with regard to risks relating to courts in Brazil. And we've seen some uncertainty there where, for example, the granting of local content waivers have been challenged in the courts, and injunctions have been injunctions, and also recent rulings that are slowing down the divestment process. So that's also a challenge or an issue for Petrobras. Now, that said, we believe that the underlying drivers are still there to support a growing space for IOCs moving forward. So lastly, I wanted to touch on Mexico. In many ways, it was Mexico's opening that unleashed the positive shift that we're talking about in the region, as countries are realizing that they may have to step up if they want to be able to be competitive with Mexico. But there's reasons to have some wondering about Mexico's own trajectory. Overall, they had a successful round one, and round two is underway. And it's interesting because it's actually domestic developments here in the US that have sparked these new questions about Mexico's oil and gas sector. And so in particular, the election of Donald Trump last November here in the US, his rhetoric on immigration, renegotiation of NAFTA, has introduced a lot of uncertainty. And specifically, it's triggered a reaction among the Mexican electorate and raised the possibility that Mexican voters may respond in kind with their own populist or nationalist candidate. And that brings us to the presidential elections in Mexico, which are scheduled for July of 2018. Now, to be sure, that's more than 12 months away, which in politics is a lifetime. But it's an evolving situation. And so we're monitoring presidential hopefuls such as Andres Manuel Lopez Obrador from the Morena Party or the National Regeneration Movement. He has run for the presidency twice before, back in 2006 and 2012, come very close to winning. But what we're doing at the moment with clients is working on scenarios, and in particular, stress testing some of the claims by these presidential candidates. Specifically, what are likely constraints on a Mexican president? So whether it's Congress, party alliances, oil price, how the situation in the US evolves. There are multiple variables, and the fact is that there is a high bar for any snap back when it comes to energy reform. Now, that said, there are less drastic changes that could slow development for operators. So we're examining those dimensions as well. So when it comes to Mexico, it is an evolving landscape. But here again, many of the drivers point to a more favorable environment for IOCs, or as we outlined earlier, towards resource maximization. So I wanted to move on to competitiveness. And as you can see here, there are numerous tenders that have been launched or anticipated for this year. Some of the more high profile rounds include round 2 in Mexico that's underway. They've got phases 1, 2, and 3 scheduled to close over the next couple of months, offering shallow water, onshore exploration, DROs, and gas discovered resource opportunities and gas-prone acreage. The last phase, around 2, is expected to include deep water and unconventionals. Also have Brazil, round 14, offering a mix of opportunities, onshore and offshore exploration in over 250 blocks. In addition to a second and third PSC round, tendering pre-salt acreage for later this year. And there's a number of countries that are also tendering offshore exploration acreage: Trinidad, Tobago, Cuba, Uruguay, Argentina. So really a lot of options on the licensing front. Now, given the number of expected rounds and other opportunities via divestments from some of the NOCs, what you're hearing more and more by folks in industry and government in Bogota, Mexico City, and Brasilia are questions about competitiveness. How do countries compare to each other along the lines of frequency of licensing rounds, local content, government take, and the like? Now, the situation's become much more pressing in the current lower oil price environment, where IOCs are being much more selective while the pool of opportunities has expanded. So to get a better grasp of competitiveness in the region, I wanted to draw from data from our commercial oil and gas risk tool, which has been developed by Wood Mackenzie and Burress Maplecroft. First, some orientation about our methodology. We assess risk across the oil and gas life cycle. So if we start with access, which is here in dark blue, when you're considering acquiring an asset or participating in a bid round, among some of the factors that feed this score are ease of entry, fiscal systems, and contract sanctity. Then you have the development stage, which is in gold, which is centered on operational risk. Key risks here are labor activism, supply chain, local content, among others. And then if you move further along the oil and gas life cycle, you've got commercialization, which we have in dark gray. Here, we're focused on where operators are trying to get their oil and gas to market. So we're assessing infrastructure, gas market access, and related risks. The higher the score, the higher the risk. To provide some perspective, we look at some scores for 2012, which you have here on your left, versus the current day in 2017. Not surprisingly, in 2012, we have Uruguay and Chile on the top, the select group of Latin American countries and Argentina and Venezuela at the bottom. Keep in mind with Argentina, this was under the previous administration, so under President Fernandez de Kirchner. Now I've placed a line demarcating higher risk countries that have scores above 10 versus those that are lower risk. Now we compare it with 2017, and what you notice is that under more pragmatic governments, you begin to register some improvements. You see aggregate risk scores improve with more countries moving above the red line. So we'll focus on a few of these countries. One is Argentina, with their score jumping from 12.25 on the left to 9.50 here on the right. This is due to an improving currency situation, better contract sanctity, reduced government intervention under the Macri government. Mexico also stands out, going from 9.75 in 2012 to 6.75 today. And that's due to energy reform and a successful round one. And so Brazil also registers some improvement. You have it going from 10.0 to 9.50 here today. But it also illustrates that while one country begins to improve, if all of your neighbors are well, you really have to do more to stand out. I think that's the overwhelming narrative that we project for the region over the rest of the decade, that there's a race to the top as governments vie for investment dollars. And so the question for us is, are we prepared as Latin America is poised to turn the corner? So I wanted to end there, but I also wanted to include a few words on Burress Maplecroft, which may be a new firm for some folks. We're a global risk analytics company anchored by holistic risk. So not only do we analyze political and economic risk, but we also assess human rights and environmental risk, really providing a 360-degree view on risk for oil and gas firms. And as Jeremy mentioned, Wood Mackenzie is our sister company. We have a strong commercial angle to our risk as well. And with that, I wanted to open it to questions.
Fantastic, thank you, and thanks for that ending. I think that's the perfect way to begin a conversation on, as you say, the race to the top. And I particularly appreciated, RoseAnne, your do more to stand out. So just a quick reminder, folks, the chat function is how we'll use the for the question and answer session here. So I will always be delighted to start the conversation. Lots of things to talk about across a variety of countries that you presented. I want to get into first here. Let's start at the end where you presented this analysis. So what is it? I mean, so you've done a very interesting analysis, and especially comparing 2012 versus 2017. But in as much as you're advising a government, let's say, what is it? What would be one or two things that you would suggest when you say do more to stand out? What is it that a bid round or a licensing round that a government is hosting this year can do to in fact stand out?
So one of the things that we've noticed, I mean, there's some of the, I hate to say it, the quick wins, if you will, the government take, fiscal incentives, making the qualification process easier when it comes to for the tenders, actual licensing rounds. So those are the easy ones. What I think increasingly is becoming perhaps could be more effective, or really what will resonate more with companies, is seeing improvements on some of those risk factors in the development stage. So those are the harder ones. So it's supply chain issues, local content, infrastructure. Because especially Latin America as a whole, I mean, this has been a challenging, companies will come in and they will invest, but then they end up stuck. And so we see that in Peru and Brazil, where entries they're able to execute that. You have countries with successful bid rounds, but then the value is lost in the development stage because pace of development is just going much slower than expected, and the companies are losing. They're losing dates are getting pushed back, and that's lost value for the companies. So I think that increasingly is going to be the differentiating factor. Is going to local content supply chain. Can the local domestic oil will the domestic oil services sector deliver? If not, is importing kit and necessary workers, is that relatively seamless? I think that's what folks are looking at, especially because it's become so competitive.
That's an interesting point, and let me pick up on exactly Peru, because I have to say, in your analysis of 2012 over 2017, I was surprised to see Peru actually losing ground. But now let me pick up on something you just said, because I think the issues of permitting and the quote unquote social license to operate, and how some of the environmental and stakeholder engagement impacts are playing into maybe delaying that kind of commercialization. Is that fair to say, that those issues of what has moved Peru down, so to speak, in your analysis?
That's precisely it. And so it's kind of you can, as a government, you can do all the right things, which is what Peru has done very doggedly. And actually, to the credit of the previous administration, it's not specific to Kaczynski, but even before him, they've done a lot of the right things. But then it's the other aspects, such as the fact that relations with local communities have not been as positive, that's when you get the delays. And so I think that those are harder issues, but if governments can improve that or make that an easier process for operators, that's really going to make a difference. And I think Peru is almost the quintessential case of where you do everything right on the government side as far as what a government can tinker with, but then it's that critical or those softer issues of community relations and the like, environmental issues, that's where they can make a big difference if they're able to crack that code on that front.
And so I think we've actually got a few questions here. Let's go to this first one from JAC, because I think it's a good segue. I think this is part of the what you're just mentioning, and part of your analysis, the risk profile. Specifically, can you comment on the various countries' regulatory regimes and how they impact competitiveness? What can the countries do? So play that a little bit more. We've been talking in some terms about that, but let's get into specifically regulatory regimes.
Yeah, so there's two fronts on that. So one is the capacity of the institution of the regulator, and so that can be a constraint in some cases where they haven't been given enough either the budget or enough personnel. And the second thing is just permitting time. And so here again, you see instances like in the case of Colombia and in Peru where it's taking much longer than it should. And there has been some progress, I think, particularly in the Colombian case, but that is an area where governments can do quite a bit, either by allocating more investment towards the regulator, boosting capacity, so that they can shrink those permitting times, because again, that's lost value for companies.
No, exactly, and I think that we had a roundtable in Mexico City at the end of February, and the exact issues were consolidating the reform, but particularly vis-a-vis how to move forward on all of these projects, particularly in light of what you commented in terms of the closing electoral cycle that's coming up pretty quick there, and some of the scenarios that could play out politically, and how important it is to consolidate some of those reform measures. So in fact, there's a specific question. Could you comment on how you expect Mexico to do with respect to the development phase of recently awarded projects? How do you see that? I mean, there's been some Pan American sputted a well on the block that they won. There's been some progress, but how do you see the development phase of what's going on with round one in Mexico?
So that's a really interesting question, and a really great question, because we can say with regard to Mexico that is the phase that presents the most risk. And when we look at Mexico's forecast out to 2020, 2022, it's that development phase in particular where risk emerges. And there's a couple of reasons for that. We've talked about that there's some really fascinating parallels between Mexico and Colombia, and in particular the Llanos Basin in Colombia. As you saw production ramp up by Pacific Rubiales, I guess at this point almost a decade ago, or yeah. Roughly, that then led to heightened expectations among the local communities. And so if you don't have if the operators and the government are not able to meet those expectations, that's when you end up with social movement, more community protests, and what we saw in the Llanos Basin in Colombia a few years back. And so that's one of the risks that we highlight for Mexico, that as you have more foreign presence, increasing output of oil and gas, that you're going to have heightened expectations among local communities. And so that's one of the vulnerabilities that we highlight for foreign operators onshore in Mexico, that does present itself in the development phase.
That's a very interesting. I mean, I think, you talked about some of the political cycle. So how far can Mexico get in terms of, to use this phrase, consolidating the reform before, let's say, a change in government? How much of the investment will flow? How much of the actual drilling and in exploring, or in some cases exploiting resources, happen, in the next 15 months?
I mean, that's the thing is, and I think that's a concern for Mexico at the moment, and that's what we're hearing from some folks, that how can they make energy reform more resilient, regardless of whoever comes into power after the elections next year. And I think because you had the gasolinazo earlier this year, the fact that AMLO, López Obrador, has been picking up steam, that perhaps the energy reform, the benefits of the energy reform haven't been clearly articulated to the electorate. And so how can the government better communicate that? Because what you would like to have is where there's sufficient buy-in that regardless of who comes into power, that energy reform is resilient.
Well, you mentioned a high bar, and I would suggest that high bar is indeed the constitutional reform. So, the question is, what can an AMLO administration do? There was the constitutional reform has set in place an institutionality, if you will, that I think is pretty strong. But I guess your point is on the margins, whether it's hitting the pause button on bidding, whether it's stepping back on some of the more aggressive 5-year outlines for gas and oil project development. Maybe that's it, where things could happen, right? And that could have an impact, especially in your competitiveness on the region when they're
That's
competing
right.
for resources.
Right.
So.
I know that's exactly it. That it is a very high bar, I think, for people who've been following Mexico very closely. I mean, energy reform, you've got, you need the 2/3 in both chambers and approval at the state level. So in that sense, it is on firmer ground. But then everything short of that a new administration may have at its disposal, whether it's slowing the permitting process, deciding to strengthen its national oil company, or have a different role for the NOC, that will alter the environment for companies on the ground.
You will be busy with your clients on Mexico's electoral cycle, I'm sure. Let's talk about. There's a question about your thoughts on Colombia. You did start getting into, I think, an interesting analysis of Pacific Rubiales, and there was the reversal of declining production in Colombia, the famous million barrel mark that they achieved. But we don't hear too much anymore about the million barrel production mark in Colombia. You talked a little bit about the permitting issues. Just a little bit in general terms, and anything you want to add on Colombia besides what we've already talked about.
Yeah, and I think, well, I guess Bogota and Colombia, the Colombian government actually specifically has been very aware about its how it rates or ranks versus its peers. I think when Mexico first opened up, I mean, I remember being in Bogota where people were asking, so will we still shine? Will we still attract attention? And the thing is that I mean, Mexico really was a game changer for the region, for Mexico's liberalization. And so the big takeaway here is the fact that Colombia is aware that it does need to continue to modify and make changes so it can continue to be attractive to foreign investment. The good news is that you have that with the Santos administration, you have a government that's keenly aware of this, and so hopefully as economic recovery picks up, that they will be able to make changes, whether it's new fiscal incentives, improving the permitting situation, so that they can continue to be appealing and competitive in what's increasingly just a crowded field.
And I think, so that's a perfect segue to question, a question about Brazil, which maybe I'll pause for now because I see some other questions that we should get to. But I want to come back to Brazil and some of the changes they made. You talked about it, but first let's look at again the competitiveness question, and I think the question about how do you see environmental issues affecting oil and gas investment in different countries could play into your analysis of competitivity. So think about it from that, but I'd like you to add also what is sort of the way to strike the right balance, because I think this is what the entire globe, the entire world struggles with. How do you balance the need for competitiveness environments, but also in a very increasingly vocal civil society, expectations sometimes outsized? How do you strike that balance between government, investors, and communities and local stakeholders?
Yeah, I think that's been a perennial challenge for Latin America in particular, and in part because you've got some very pristine areas in our region. So whether it's Peru and parts of Brazil, they're kind of front and center of the debate. I think that what we've seen in Peru, specifically Peru and Ecuador, there's at least a recognition that they do have to find this balance, that the status quo, which had been okay, the governments will grant the licenses and then leave operators to their own, to fend for themselves, if you will.
Right.
There's an awareness that that just is not going to work. So I think that's the first step. But we're still very much, to be honest, still a learning curve on what it is that needs to be done, whether it's more communication, better buy-in. I think, the fact that securing social license to operate is now very much part of the usual, the basic discussion in country entry, which maybe 10 years ago or 15 years ago, it might not have been, is a step in the right direction. But that's very much a work in progress. The good thing is, though, is that I think that it will be operators and government officials in our region, so in Peru and Ecuador and Brazil, that will likely be at the forefront of reaching a kind of that balance, because they have to if they want to see their sector progress. So I see a question about Guyana, which I can also comment on. I know that we had mentioned Guyana in the initial announcement for this talk. It kind of got left by the wayside a bit because of the larger countries, but a bit on Guyana. I mean, under President David Granger, they are making a lot of the right signals, laying the groundwork for the onset of oil production post 2020. They've announced they'd like to have a sovereign wealth fund. They plan to earmark, I believe, upwards of 30% of revenues generated for this fund. They're establishing good oil and gas governance, at least on the institutional side of things. The fact that they're not afraid to ask for help to avoid the mistakes of other frontier countries, all of this is, these are favorable developments. I think the pressure that we're watching or that we're monitoring is in anticipation of the elections in May 2020, and right before a lot of this oil revenue is expected to flow. The fact is that the current government won the 2015 presidential elections by a razor-thin margin, and so there could be a lot of pressure from the opposition to really have something to show with these expected oil revenues. And so that's one thing that we're watching, is that, again, that kind of pressure on populist spending potentially. But otherwise, I think, at least currently looking at what the government has stated in their actions, they are doing a lot of the right things, especially for a frontier country.
Thank you, RoseAnne.
I see the question on regional integration of gas, access to gas for Chile. I have to say I haven't followed the Southern Cone gas story as much as of late, so I wouldn't be able to comment too much, I'm afraid. One question from Jeremy about the Vaca Muerta deal, whether it's replicable in other plays in Argentina. I think it really, so it was very notable in the fact that it really did integrate all the stakeholders. You had the government at the federal and state level, you had the unions, you had the operators, the service companies, everyone had a seat at the table. And so that was, I think, very remarkable. Whether it can be mimicked in other parts of Argentina, there's a few things to note. And one is that, generally speaking, the view is that in Neuquén, at least the government at the local, at the state level, tends to be a little bit more pro-business, so attuned to the fact that they do perhaps need to make more concessions, or aware of the shortcomings in their province, and that may not be the case in a lot of the other provinces. And the other thing to note is labor, and here again, it varies quite a bit from province to province. In the Argentinian case, with, for example, in the southern provinces, labor negotiations are much more difficult. It's a much more mobilized labor movement in the south, and so I'm not sure that you would be able to get the concessions that we saw in the Vaca Muerta agreement earlier this year in other parts of Argentina. I guess it would depend on what how locals see the situation, how much pain are they feeling with regard, as as prices become aligned more with the global market, do locals and do stakeholders recognize that there's a benefit to concessions to reach these types of agreements? Because to be sure, everyone has to contribute to reach these deals.
Hey, RoseAnne, I'm on the phone here. Hopefully you can hear me okay. Sorry, I don't know what happened. I got kicked off the audio for a little bit on the platform, but I appreciate you bearing with it and taking the Guyana question. In fact, I wanted to get into Guyana a little bit. It seems to be a very interesting development as part of sort of this broader race to the top, as you call it. Let me ask one final question and give anyone the last chance to pose something as we're heading towards the wrap-up of the webinar here. I'm going to go back to Brazil because I think that's a place where, again, sort of aligning some of the changes with competitiveness, I want to get some further thoughts from you about are the changes enough, so to speak, for the 2017 bid rounds? And there's going to be several, and there's going to be a very aggressive auction cycle this year. As a matter of fact, Décio Done, who was installed as the head of AMP earlier this year, is coming to La Jolla conference to indeed tout Brazil's bid rounds in 2017, and they're pushing very hard to compete for those dollars you talked about. Just your insights and some of your analysis on those changes, and do they amount to enough for this year's bid rounds?
In general, I would say that at least in print, if you look at, again, the local content, the fact that they lowered local content minimums for the pre-salt tenders and for round 14, all of that is good. But then you have the reality of that you have the courts, they've been quite active. You have other stakeholders, whether it's the unions or other industry lobby groups pushing back on some of these initiatives by the government. So that does create pause for some companies, particularly for those who are new to Brazil. I think those that are already in Brazil, they already have a footprint there. They're already exposed, that they are perhaps potentially, they're already exposed, so they can deal with kind of the day-to-day challenges or the day-to-day issues in Brazil. But for newcomers, given the flurry of news that we're getting, probably, at least probably every couple of weeks on court injunctions and the like regarding local content or divestments, it does create pause for some folks. So a lot of good news coming from the government side, but then we see other developments that do it does generate some uncertainty, which for some folks, they want to see a little bit calmer environment before coming in.
So going back to, I keep quoting some of what you said, do more to stand out still is, although there's been a lot done in Brazil, there's been a lot of regulatory changes and adjustments and on elements that people have pointed to, the operatorship, for example, on pre-salt, and as well as some of the onerous local content. There still may not be enough, I guess, is a quick summary. But stay tuned also, because I think some of the opportunities there are such that maybe there's enough of a balance in terms of the changes vis-a-vis the opportunity, right?
Exactly.
Well, I'm going to wrap up here. It's right before the hour. It's almost noon here in La Jolla. And I want to thank RoseAnne Franco again for her time. This has been a fascinating conversation. And, there's a lot more we could keep talking about, especially the political cycle in Argentina and Mexico. But I think we've talked a lot here and covered a lot of ground, including Guyana, which is another place that I think, if you mentioned, if we'd been talking about the stakeholder engagement 10 years ago we probably wouldn't have been talking about stakeholder engagement. I don't think we would have been talking about Guyana in terms of Latin America's oil and gas outlook 10 years ago either. So it's very interesting how things have changed and how 2017 is, as you said, these last couple of years, an inflection point for the region's outlook in oil and gas. So thanks so much for your insights, and particularly your sharing with us your model on how to assess some of the competitive elements and access and commerciality of the countries of the region.
Thank you, Jeremy. Always a pleasure.
So final word here, don't forget to join us May 24th and 25th here in La Jolla. We'll be talking about all these issues in much greater detail, and we'll see how the folks from ANP, CNH, and as well as the governments of Argentina and across the region respond to some of these questions that we've covered this morning and this afternoon. So thanks everyone for joining us. We look forward to seeing you in person or online again soon. Stay tuned for future announcements, but again, don't forget to come join us here in La Jolla in May. Thanks again, RoseAnne, and thanks everybody. Have a wonderful day.
Thank you.